I want to talk about the tariffs and the deficit spending
Yep.
and the deficit itself. And so, because
Which kind of ties into
we're
that,
in this
right?
weird space, Craig, go ahead.
Yep. Which kind of ties into, I mean, that's what sparked that conversation about what naturally happened and occurs and what's being implemented or impacted by policy and adjustments. And then, of course, is it Trump's policies or is it something that was building up under the previous administration? And then it's just kind of letting go or unwinding with anticipation of what we anticipate going forward for the next couple of years. And how long is that going to look? What are business owners concerned about, both small, medium, and large businesses, because all of them deal with trade in some form or another. They all You have some that have already been domestic that have seen a lot of their business contract that are looking to expand. I know of several businesses right now that are in the steel business, the rubber business, or tire business that had lost contracts, large contracts to foreign companies that have now, a lot of those distributors have come back to them already to where they were running one shift and now they're back up and running three shifts. So you see that ability or that strength coming back within the manufacturing area, which you saw at one point in time, our manufacturing was 25% of our population was involved in manufacturing. That shrank to 10% over the last 30 to 40 years. You've seen the shrinking of our middle class over that last 30 to 40 years as well. And you saw the increase of the lower class and increase of the elite class. So you have that adjustments and changes, and then we have a huge policy change that we don't know exactly what that is going to be like over these next couple of years. We don't know exactly what that's going to look like, to be quite frank. And then having the ability to adjust, to be able to take a look what sectors of the markets are going to benefit and which ones are maybe impacted more negatively, getting in, getting out. It is not an easy thing or an easy environment to be in when you're especially investing into the markets, which because of that is why you had a huge pullback after quote unquote Liberation Day, the 2nd of April. The markets were already having a level of correction that were looking to go down to a 10% draw because, like I mentioned earlier in the previous segment, you can almost peg it to the day of the being of the 19th of February. And through the rest of February, the markets were down. Through the entire month of March was negative. And then we're having somewhat of a rebound. And then all of a sudden on Wednesday, the markets really pulled back significantly over the next 4 or 5 days, where you saw the markets dropping 5, 6, 7%, and the next day another 5, 6, 7%, to where we're approaching bear market territory from the beginning of the year. Now, a lot of that, because early in May now, a lot of that has already come back. So April was a very tough month over that time period, to where you don't want to necessarily get out and then get out at the bottom, because one day in there, one day, the markets were up double digits in one day. And so it recouped significantly over that time period. And so that is where understanding the investment discipline that you find yourself in, you've got to be and want to be prepared for those down markets and have confidence in the strategy that you've implemented 6 months prior, a year prior, 5 years prior, and not make adjustments based on emotion.
Craig, how do you want people to get a hold of you and meet you and see your wildness? How would you like people to
The,
connect with
the
you?
easiest the easiest thing is to type my name and basically Google or search my name and then at Ameriprise, and you'll come up with my website. And there's actually a way to coordinate a meeting or schedule a meeting for you on my website. So I'll get immediately contacted and then can coordinate meetings that way as well. So that's usually the easiest. The other is you can call my office directly, 517-483-4893. Again, it's 517-483-4893. That's my direct line. Leave a message with a number and or email address, and I can follow back up with you, and we can coordinate a time to sit down and talk about what you're looking to do, what you're needing to do as it relates to your overall personal finance or business finance or endowments or foundations, whatever the structure might be.
Is in your opinion, Craig, is the administration of President Trump? What's your vibe on the tariffs and the marketing aspect of it? Do you agree with what I'm saying? Is there a partial agreement? What do you think?
Well, there's when you're talking about from a marketing perspective, a lot of it comes to the area of trying to understand the impact of tariffs and the negative impact that it's had on the United States. And what I mean by the negative impact has been, we're talking about the United States applying tariffs. Nobody is talking about tariffs being applied to the United States. Now they'll touch on, well, why is it that there are some countries out there that are not having tariffs against the United States? And they will focus on those countries, but they will not focus on the countries that have been applying a tariff to the United States products, or limiting, if not completely blocking out certain industries from even selling to their countries, where we take a look, what product are we not allowing into our country that we purchase and buy and sell? The other dynamic has been the impact of globalization as a whole, because the other arguments that I hear, well, globalization's been good for every country. It's raised the lifestyle of every country. But they have to remember, every country is not a democratically elected republic. Republic is kind of the key word as it relates to the nature of the rules of subsidiarity, local decision-making, all of that. So if not all of the major playing fields are the same when it comes to tariffs, you have government entities applying taxes on products from the United States going there. Well, those taxes that are being applied from other countries are not going to benefit the people. It's going to benefit the country or the government. And so when we sit there and think it's raising the lifestyle of everybody, it's not the case. We know that. So how is it that our country has accumulated $36 to $37 trillion in debt? Has other countries accumulated that level of debt as well? Does that mean that we have raised that level of debt because we've kind of funded the growth of every country in the world? I'm speculating when it comes to that digression, but when I sit there and think of how the free trade agreement worked, okay, we're providing a North Atlantic free trade, but what country or what industries were actually involved? Is it truly been free trade with Canada, truly free trade with Mexico, or was it just an arrangement where we can manufacture property or manufacture products less expensive in the other countries and then sell them back to our own citizenry? And that's where, how do we go about disrupting what has been in play for the last 30 to 40 years? And I think that's what happened on Liberation Day, April 2nd, when we had a huge policy shift of tariffs across the board on every product coming into the United States. That was one level of uncertainty taking place in the markets. The size of reciprocal tariffs, that was starting to open the eyes as to how much products, how many of our products were actually being huge tariffed in other countries, number two. Number three, there are countries that we did not have, that we're not charging tariffs, but we are to those other countries, and that was the application of a deficit difference between that country and ours. Those three primary pieces of uncertainty, if you will, or areas of tariffs, created an uncertainty of what was going to be happening within the markets. Therefore, you had a lot of entities getting out of the markets in general, which you had a huge downturn. Once all that stuff started shuffling through, then the market started correcting and coming back up again.
I look at that and read that, and I'm like, listen to Craig. He just told you guys all this, and then I've had this thing. What do you think about that, Craig? Just said, reinforcing exactly what you were saying.
Yep. And you'll see that again, that's reinforcing the fact of it being a rather common occurrence of what level of corrections you can expect during a 12-month period of time. And then the reasons why you don't want to try to time the markets or get out, because you have some of the strongest rebounds that occur within the markets happen during the most volatile times in the markets. And if you miss those time periods, regardless of how many times you try to time the market right, it will impact your long-term performance on your portfolio. So that is where having a solid discipline within your portfolio and expectations of understanding in the markets will benefit you over the intermediate, if not long term. the short term, it does get scary. And sometimes if clients are living off of their portfolios, may have to pull back, say, you know what, we're looking at buying that car this month. We may push it off another month or two, where, we're looking at maybe going out to eat. And, maybe we will go out to eat this time period, because if I do that, I'm going to have to draw off my portfolio, whatever it might be. Or if we have clients already taking automatic withdrawals, we don't increase that withdrawal. We just continue on and maintain it. If the markets are down, we know that the markets are going to be rebounding at some point. So the impact of that withdrawal rate, I want to make sure, and that's why, we've had that conversation, right?
We have. I was just
Anticipate anywhere from a 4 to 6% withdrawal rate, net of everything, regardless if we started today and the markets dropped 20% the next day. I still would be happy and comfortable with you taking the withdrawals at the 4 to 6% withdrawal rate.
Yep.
Why do I say that time period? Because that's historically what endowments and foundations do in order to maintain their portfolios into perpetuity. Some clients are taking more, some clients are taking less. The ones that take more, I have to be more aggressive in the portfolio because we need the greater returns. Understanding that if we're more aggressive in the strategy, they will have more volatility and could have a deeper downturn when the markets have a level of correction.
How do we sort of rein this in? I mean, we can never eliminate it, but talk.
The hard part is where the deficit spending is coming from. Like when we talk about the universities and everything along those lines, they've become very dependent upon government contributions.
Yeah. Okay.
Quite frankly, I mean, because at one point in time, the way that schools would make and earn their money is the value of their education or the value of their research. A person they would justify their cost for their education. So supply and demand. A
Right.
lot of areas, if you had free market for supply and demand, and you only have 30 seats that you can put kids into a particular class, those 30 seats are going to become more and more and more and more valuable the more people want to take that particular class or go to that particular school. And so that can justify an increase in tuition and increase that can allow for expansion and growth within that area, to where if you're earning more money than what your expenses are going out, then you're not going to have to rely on outside resources to supplement that growth or that expansion. That is kind of what deficit spending, if you have anticipated growth, you can justify some of that by going out and getting a loan to grow and expand. But typically that's if you're have a positive growth. In other words, the money that you have coming in that's growing organically, that is what would be taking place. But if you are relying on grants or money coming in that isn't being generated in-house, and then you're expanding departments that are relying on this, and sometimes that comes in as a guise of research. All right, if we're going to research this, but we don't have anybody that really wants to pay this, let's apply for a grant from the federal government. They'll get a grant. Okay, that's not expected to be forever. And those grants sometimes are only meant to be for a short period of time, but then, well, we'll just apply for a continued grant or continued grant. Well, then what's going to be the result of what comes out of those grants?
Right.
And that is where that is where the deficit spending can be, to where now you're an entity that has now dependent upon that income, and that you've built a whole facility to do this type of research. Well, where's the value of the research? Can you get outside investments to come back in that can benefit from that research a little bit later on? Different universities will apply that research differently, will apply their education a little bit differently. And so this obviously gets outside the finance realm a little bit. But that is what I think really drives a lot of the deficit spending, especially when you're coming at from a school's level or perspective. Driving it home from a personal level, yeah. If you have a $5,000 limit on your credit card, and you're only making $4,000 a month, and you're spending $4,500 on your credit card every month because you can, how are you going to spend or buy that extra 500 or pay back that extra $500 if you're only making $4,000 a year or a month, right? And if you're going through making that $4,000 a month and you spend on your credit card, and if you spent it on going out to eat, buying certain things for your apartment or your house or whatever it is, and you forget, oh wait, I gotta make a payment for my apartment. So if you're only making $4,000 a month and your apartment's $1,200, and you have a $4,500 credit card bill, now you're a couple $1,000s in debt on a monthly basis. Having that discipline to pull back and live within one's means, so this way you can save enough so that way you can start investing what you're saving, allow your investments to grow. So now your investments can then be that additional income to meet your needs going forward.
Mm-hmm.
That is what we kind of miss out on, that building of wealth through disciplined spending.
Should age affect decisions in our managed portfolio during financial craziness? Tough question. Threw you a curveball, didn't I? Got to think
Well,
one.
yes, I'm just sitting there thinking of a couple of different ways to answer that and think of one that is more direct. So, when I sit down and when a financial advisor should be talking about is what their expectations are during retirement. So, in my circumstance, as you're aware, a majority of my clients are 80%, 90% in equities to begin with. There's only two things that are going on in the markets, whether you're buying bonds, whether you're buying anything, or in the markets in general, is you're buying something and you're selling something. You can buy a bond and you can sell a bond for a loss. You can buy a stock and you sell a stock for a loss. When they buy a stock, when they buy a bond, when they sell a stock, when they sell a bond, creates a statistic. And believe it or not, there are some people who are better at it, have specific investment disciplines. And then we try to match those types of investment strategies with the tolerance level of our clients and then educate them on what those pros and cons are of the decision we make, right? I mean, just to use your example, we did make an adjustment. When you needed to take a little extra, we made an adjustment with one of the strategies as a part of the portfolio,
Yep.
maintain growth, but this strategy is more dynamic and changes more rapidly than the others that are stayed focused and in their lane, so to speak. One kind of changes lanes a little bit. And that has done well for you as it relates to the pullback in the market. It's a growth strategy, didn't pull back as much. They're capturing a little more on the upside. That
I made
adjustment,
a good move.
that adjustment isn't based on your age. It's based on the desire and need to withdraw a little bit extra for
Yep.
whatever the next phase is, right?
Exactly.
So it's always not focused on age, it's focused on what the client needs their portfolio to do. And then match that with who they are, what their personality is like, their ability to handle investment tolerance, whatever it might be. So
Give me a 30-second takeaway, and I want to give you a comment on that. Go ahead. Give me a 30-second takeaway.
So from that perspective, it's not about age. It's about what that person needs to live off of, and then match their investment discipline with their lifestyle.
Love that guy so much. Craig Stiles, financial craziness. Should age affect decisions? Never. Or it depends. How's that? How's that for a bounce on my answer? But listen, everybody, having an actively managed portfolio with a guy or a company like a Craig Stiles, whoever you find people that you trust. I mean, it's so important. So I'm going to leave you with that. Please go check out any of those episodes, all of our episodes on our website, TomMattShow.com. We love you all. We thank you so much for helping us get to that almost 3 million view spot on YouTube. We're getting there. I want to get to 10 million views. One of my goals in my life. And once we hit 10, it's onward to 100. So until then, peace out, everybody. I'm Papa Tom. We'll talk to you next time. We're done.